Our next guest says earnings expectations going into this reporting season have not been revised down as much as normal, and the bar is higher. Joining us now is Gabriela Santos, JP Morgan Asset Management Global Market Strategist. Gabriela, good to see you here. Your initial take on earnings season. We're seeing a lot of companies beat big, like GE. Wow, where did that quarter come from this morning? But not really seeing that big pop. What's the problem here?
Great to see you. And I think the problem is expectations. So if you remember the first quarter earnings season, expectations from analysts have been revised down substantially. The second quarter, not the same trend. Actually, earnings expectations have gotten revised less than is what's normal for 5 years, 10 years, 15-year average. And those are analysts. Investor expectations are even higher than that. If we look at a measure of sentiment like the AAII Bull Bear survey, investors are now very, very bullish, the most bullish in 15 months. So I think that's the problem. Expectations are high, so just beating those expectations is just not good enough at this moment.
Well, is the read through there, Gabriela, that the overall market might be overvalued here, and then once these earnings reports die down in about a week or two, we could be looking at a pretty swift summer sell-off?
So I think it does open up the possibility of a pullback. When you have expectations that are too high, the delivery just doesn't quite match up, and then you get a reset in prices, in valuations. What I do think is important to kind of sift through is that we fundamentally believe that the bear market is over. We're now up 26% from the lows. We're just 5% from the highs. We have begun a new cyclical bull market. So we're back to just talking about normal pullbacks driven by elevated sentiment, stretched positioning, and a reset in expectations before we get the next leg higher. So we would, at this point, be neutral equities. It's no longer the time to be underweight. It's just taking into account how much expectations have run and not getting too far in your skis either.
I mean, we're talking about, though, I'm sorry, I'm just doing a quick math here. I mean, the S&P hasn't done so poorly since the beginning of earnings season. Yes, maybe individual companies have gotten punished. We're still up about 1%, which is not fantastic.
Yeah.
But we're talking about a little more than a week into earnings. Not impressed?
Not impressed.
And now is crunch time,
yes,
right? Because we do get those big heavyweight tech companies starting to report this evening and over the next few days. And that's where expectations are particularly high already in terms of multiples. They're driven more by the future enthusiasm about artificial intelligence. But even just earnings expectations, there is an expectation that the earnings contraction from last year might be over, that companies have done enough to raise revenue and to cut costs, and that's where we need to see the follow through, and that's what leaves the market a little bit more vulnerable going forward.
So help investors understand this, Gabriela. I know you can't talk specific names, but let's say Apple comes out here, beats by 10 cents, next day stock goes down 2 or 3%. Is that the ultimate sell signal inside of this bull market you're talking about?
Well, I think
short term.
Sure. And I think we have to look at each individual company. Sometimes there is just a silly overreaction to some kind of earnings miss, and then eventually the stock recovers because it's really based on long-term expectations of earnings growth. But for some companies, it might be an important signal that expectations were not accurate. And I think that's especially important for the tech adjacent sector. We were just discussing certain companies like Spotify and Netflix, and this change in investor demand for profitability now. Right? So longer the days of
Spotify being an example, perhaps.
And those kind of companies, just a macro example of the environment has changed. Now that we have positive real rates, investors have other options. It's about which companies are able to raise enough revenue, cut enough costs to become profitable in a 3 to 5 year window, not an eternity kind of window. And that's where we've seen this before after the tech bubble. It's really important to sift through the winners and the losers. Some prices might not ever recover post sell-off last year.
I quickly want to ask about rates too and how that relates back to all of this, because of course, during that sell-off, higher rates were a big concern for tech companies. Now the sort of looking past the rate hiking cycle is one of the things that's perhaps helped tech companies. But does that now become, at this juncture, does that become less important? And this idea of profitability and specific company earnings become more important?
I do think so. I think what the shock was the realization last year that we truly were done with zero interest rate policy, and that we were now going back to a regime of positive real rates, and that investors, companies had to readjust their expectations and their business models and had to focus on profitability once again. I think we're now at a point where we understand that, and now it's actually seeing the results company by company. I also think there is this willingness to look through this last rate hike that we expect tomorrow and more focusing on what's ahead, the other side of the mountain, the interest rate cuts and the normalization of interest rates in 2024 and 2025.
I have to give my friends at Barron's a shout out. Good story on their page this morning looking at dividend stocks. So when inflation is starting to cool, some of the best trades or best investments you can make are in high-paying, high-class dividend payers. Is that the place to look as an investor right now, or do you stay with these momentum names?
We do think income is such an important piece of total return for equities over time. It's not just the price appreciation, it's the dividend. Long term, it contributes about 50% of your total return. When it comes to dividend payers, we think the most important is the consistency of that dividend and not just paying, looking at which company is providing the highest dividend right now, which might be unsustainable. But dividend paying is very, very important. And those tend to be quality companies that are able to maintain that income over time. And I do think the return of dividend paying stocks is aligned with this idea that cash is paying 5.5% now, but eventually we'll go back to more normal interest rates, which we would consider 2.5%, 3%, and then the dividend that these companies pay all of a sudden becomes more competitive, plus the price appreciation, and you get a better total return out of them.
So
no dividend for Spotify. Sorry,
So do you start to rotate out of cash or out of some of your fixed income positions into dividends, or is it still a little early to do that?
We do believe ultimately that, hard landing or not, interest rates are too high. And expectations for interest rates in 2024 and 2025 are too high. Expectations for 2025 are for rates to be nearly 4%. A neutral rate is 2.5%. So those rates on the short end of the curve need to come down, and that's pretty independent of the cyclical discussion of the economy. So what that means is that actually cash is a pretty dangerous place to be from here on out. It has a role if you need liquidity. It is paying some income now, but it can't be the whole solution. And whether that's stepping into adding duration in fixed income to lock in the higher coupons, benefit from the price appreciation when those yields fall, or whether that's starting to move into more defensive equities, which we would consider income paying or sustainably income paying equities to serve that role as well.